Good evening, guys. Today in this video I'll be talking about break of market structure versus liquidity grab. Right, I'll be talking about the difference between the break of market structure and a liquidity grab. A quick disclaimer is that the definition I use in this video are not official definition, but only my understanding of what I see in the market to make sense of price delivery. According to me, a break of structure or a break of market structure mostly occur when the market is trending in a certain direction over some time. This is characterized by the market breaking the previous structural point. This is what I mean. If you can see at this on the left side of your screen and look at this diagram here, you realize that we have a trending market that is bearish. What I mean, we have a trending market that is going down. This market is characterized by the market making lower lows and breaking lower lows, making lower lows and breaking lower lows. So the market makes from this swing high, the market makes this swing low, and it makes a lower high, which is relatively lower than this high, the previous high. So, and the market comes and it breaks this swing low, the previous swing low. This break of this swing low is known as a break in market structure. This break of in market structure tells us that the market is still bearish. The market makes a lower low again, and it makes a lower high. It again moves and breaks this swing low, this lower low, to create another lower low. So we have another break of market structure here. It created this lower low, and again it creates a higher low, and again it breaks this lower low. We have another break of market structure. What this means is that the market is bearish. I think price delivery that keeps on breaking the previous swing lows means that the market is bearish, and we expect bearish price until to the point where we see the market moves up and breaks the swing high. If it breaks the swing high and go up, then that's when we realize that the market is changing direction. This is essentially what the break of structure is. Liquidity grabs are movement in price which are opposite to what the actual trend is, in that it creates fake out to induce people to enter trades just for the market to move in the opposite direction. Right? What I mean by that is, if you can look at this on the right hand side of your screen, we realize that this is also a bearish movement. How do we know that it's a bearish movement? Because we have a swing high and a swing low. This is our displacement high and our displacement low. What we look for to determine price is, if price breaks the swing high, we are going bullish. If price breaks the swing low, we are going bearish. Now the market makes a swing high, which is a higher low, yeah, a lower high, excuse me. This is a lower high, and from this lower high, it breaks this lower low. This was our lower low, which was broken here. By the minute this occurs, then we know that we're in a bearish trend. The market again makes a lower low and makes a lower high. It's a lower high because it's lower than the previous high. The market comes and create this what is known as relative equal lows. Relative equal lows means that there's tons of liquidity down here, so the market cannot move in any direction without first creating this liquidity. What liquidity grab then means is, we have this high this lower high, which was created prior to creating this equal lows. So what this means is, this is our swing high and this is our swing low, and this swing low becomes relative equal low. Then the market moves here and it breaks this swing low. When it breaks this swing high, because we understand that we are in a bearish movement, this swing high is known as a fake out. This is what we know as a liquidity grab. Why is it like a liquidity grab? Because the market broke a swing high in a bearish movement. We expect the market to go down, especially because the market made this low equal lows. So we expect the market, so the market makes this is what is known as a liquidity grab. Then the market moves into a certain direction, and again it breaks this relative equal lows, creating a lower low again. Uh, this is a market. This is the market doing a fake out, a liquidity grab. So people, when this thing is trending, whenever this swing high is broken and this swing high is made, then this swing high, this swing low is broken. People assume what? People move their stop loss from this swing high to this swing low, and the market comes after the stop loss and it takes out the stop loss to go into the opposite direction. Okay, guys. Now that we have already talked about the theory part of the breakout structure versus the liquidity grab, now we are going to jump into the market and look at a few examples of what a breakout structure is and what is a liquidity grab. So let's recap. A breakout structure, according to me, mostly occurs when the market is trending in a certain direction over some time. This is characterized by the market breaking previous structural point. What I mean by structural point is, if you look at this chart, you realize that the market from here, the market made a low, then made a higher high, then made a higher low, then made a higher high, breaking this structure. We have a break of structure to the upside. We have a break of structure to the upside here. But from here, from this higher high, the market went and made a lower low, breaking this structure. So when this structure was broken here, it signals a market structure change. This is a break of structure. It signals that a market structure shift will occur. So when we finally break this low here, this swing low here, then that's when it's confirmed that we have a market structure shift. That means now we're expecting bearish movement. We are no longer expecting higher highs and higher lows. Now we're expecting lower lows and lower highs. So the market made this low. From this low, the market made this high, then break structure to the downside to make this lower low. This is a lower low that I'm talking about. A lower low. This is a break of structure to the downside again. This is a lower low. Then from here, the market didn't make a higher high. It made a higher low. A lower high, I mean, it made a lower high. It failed to break this structure here. So when it fails to break this structure, this becomes a lower high. And again, the market breaks structure to the downside to create another lower low, then make a lower high, then break structure to the downside and made a lower low. All this, what all this tells us that is the market is bearish. So we have a break of structure because the market is breaking the previous swing point. In this instant, the market is breaking the previous swing low to continue going down to make lower lows. So if you come here, you realize that the market made a lower low here, and when you look at to your left, you realize that now we have equal or relative equal lows. These are equal lows. So what does this tell us? This says to us that the market created liquidity. This is inducement. The market induces buyers to say, okay, the market came here and now it broke structure to the upside. So people will look at this as a break of structure to the upside. But what we know as SMC traders, you know that whenever we see equal or relative equal lows, there's liquidity below that low. So we have this relative equal lows and we have this imbalance here. So we can assume that the market was edging towards this imbalance. So we know that the market cannot make equal lows and leave the liquidity that untapped. And also we have a higher time frame PD array here in the form of a weekly piece. So the market create this low to induce, and when the market breaks this high here, the people are looking for the market to come and retrace into this and this act as support, then they buy the market. So when they buy the market then break this low again. Now this now here, because these are equal lows, these are equal lows, there's liquidity. This is no longer a break in market structure. When it comes here, because below every equal lows there's a tons of liquidity. So now we're expecting the market to say, okay, because there's liquidity here, this is not a breakout structure, but instead this is a liquidity grab. Right? No, now we get into the concept of a liquidity grab. The liquidity grab started from up here. So what is a liquidity gap? A liquidity gaps are movement in price which are opposite to what the actual trend is, in that it creates fake out to induce people to enter trades, just for the market to move into the opposite direction. So when the market made this low and again made this high, this is a high because it's higher than this this previous high. So when this occurred, people thought this is a break of structure, so that the market is now changing direction and now it's going to go up. But what we know is the market cannot leave this liquidity untapped, and it has to come into this fair value gap for going up. So this intent becomes our liquidity gap. Why is it our liquidity gap? Because the base movement, the base movement is down. The base movement is down. We have, this is a bearish movement. Until we get into this fair value gap, this higher time frame PD array, we expect the market to keep on going down, right? So the market cannot go up before taking this liquidity, before clearing this liquidity and tapping into this fair value gap. So this becomes a liquidity gap. And when it comes down here, because now we know that we have liquidity here, so this becomes a liquidity gap also, no longer a break in market structure, because we are not breaking market structure. We are taking liquidity in order to introduce more liquidity into the market so that the market can take price higher, right? So when the market taps in here, now we know that the market has no reason to keep on going up, to keep on going down, sorry, to keep on going down. So now when from this position here, we are now looking for buy position. So now we have another break. This becomes a break of structure. This is a break of structure, right? This is a break of structure. This now when we have this break of structure, this liquidity sweep changes to become a break of structure. Why is it the break of structure? Because wherever the market breaks structure or breaks the previous swing in that direction, that's a break of structure. Then the second break of swing becomes our liquidity gap. So the market broke this high here. We have a break of structure signaling to us that the market is ready to go up, but the market cannot go up before clearing this liquidity and tapping into this high time frame period in the form of a piece. So now we have a break of structure, we have a liquidity sweep, right? Now we expect price to go up, 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 up. So the market creates a high, creates a low, creates a high, creates a low, then the market is now here. Okay, guys, simple as that. This is basics structure. If you want me to make a video about a more advanced structure, maybe I'll do that in the next 2 or 3 weeks. I'll be discussing the advanced market structure, but for now, just know the basic market structure. And how you trade them is like with everything. You wait for the market to grab liquidity, sweep out liquidity in the market, then break structure into the opposite direction. Now we're looking for buy because of this break of structure. Then you look for your PD array where you can take buys. You look for your breaker blocks or your fair value gap. Oh, sorry, this is a break. Our breaker block is here. Our breaker block is here. You can use the 50% of the breaker block or the 50% of the fair value gap, whichever one you prefer. Or you can even use the order block. So you have many confluences here. You have this order block, you have an order block, you have a fair value gap, and you have a breaker block. You can buy either here at the 50% of the breaker block, you can buy at the order block, or even if you want, you can search for the 50% of the order block, which I do not. It didn't reach the 50% of the order block, but in fact the order block is gonna be here. Yeah, this will be order block, so it reached 50% of your order block, and it's also aligned with the 50% of the fair value gap, so you can take your entries at any of them. Okay, guys, if you have made it this far into the video, that means you enjoyed this video. Please consider subscribing, liking, and commenting under this video with suggestion for further videos. Peace out till we meet again next time.